Welcome to the PAI Morning Briefing. I'm your host from Pantheon AR, and today is March 6th, 2025. Good morning, everyone. I'm delighted to have you join me on this crisp, insightful day as we break down the state of our markets and explore the stories making headlines from Wall Street to the global stage. Let's jump right in.
Let's begin with a quick market overview. Yesterday, we witnessed a mixed bag of movements across the major indexes. The S&P 500 closed at roughly 5,767, down by about negative 0.32%. The Dow Jones failed to find its stride as well, dropping to around 42,527, marking a decline of approximately negative 0.75%. Meanwhile, the Nasdaq managed a slight recovery, ticking up to nearly 18,261 with an increase of about 0.3%. Over in the smaller cap arena, the Russell 2000, a widely followed benchmark for small cap stocks, slid to roughly 2,065.9, echoing the downbeat sentiment with a drop of nearly negative 0.75%.
If you're keeping a close eye on digital assets, Bitcoin settled at nearly 90,196, recording a decline of around negative 0.46%, while Ethereum closed the day at roughly 2,223, down by almost negative 0.84%. These moves, though modest, underscore the broader uncertainty we are observing across traditional as well as digital markets.
Now let's transition into a deep dive into major market trends sweeping through our financial landscape. What we've seen recently is a real test of market resilience. Traditional equities are grappling with headwinds from both domestic economic data and global trade concerns, while digital currencies, as many of you know, continue to oscillate in response to regulatory developments and broader investor sentiment. Behind the numbers lies an ever-evolving narrative. Companies are recalibrating their expectations in light of geopolitical tensions, fluctuating consumer demand, and shifting supply chain dynamics.
On one hand, we are observing cautious sentiment in the U.S. market thanks to persistent headwinds linked to trade data. Speaking of trade, massive shifts in the international trade balance have been a major focus this week. The government released data showing that the U.S. trade deficit ballooned to a record high in January. According to the Commerce Department, the deficit widened by 34% compared to previous months, reaching $131.4 billion. This is the widest gap we have seen since records began back in 1992. The surge clearly signals that companies faced with tariffs and other protectionist measures are scrambling to import goods to stay competitive, even as domestic production struggles to catch up with demand.
In addition to the trade news, another economic indicator on our radar is the trend in jobless claims. Although we're seeing a receding pattern from a 3-month high, recent filings among federal workers suggest that unemployment claims could witness a resurgence. The initial signs indicate that the true extent of job losses in the public sector may only fully reveal itself in the coming months, prompting policymakers to once again carefully weigh labor market interventions.
Another trend that has captured the attention of financial institutions and hedge funds alike is the shift in sentiment among market professionals. A recent analysis by J.P. Morgan highlights that although hedge funds still maintain substantial exposures in the market, they are noticeably less bullish than in previous cycles. This tempered optimism points to a cautious reevaluation of risk amid the current economic landscape, with portfolio managers closely monitoring trailing indicators and adjusting their positions in anticipation of further market volatility.
Beyond these macro concerns, individual companies are also navigating their own unique challenges and opportunities. In the realm of space exploration, Intuitive Machines made headlines with plans for its second moon landing scheduled for Thursday. Despite the excitement surrounding this historic endeavor, the company's stock has been under pressure. Investors remain divided, balancing the promise of future growth in the space sector with the inherent risks of ambitious, capital-intensive projects.
Meanwhile, in the retail sector, major players are showcasing divergent faiths. Macy's, for example, has seen its stock fall following an announcement of revised guidance amid what the company calls external uncertainties. This prudent approach to recalibrating expectations comes at a time when several other retailers are battling similar headwinds, from supply chain disruptions to shifting consumer behavior in a post-pandemic economy. On the flip side, BJ's Wholesale Club is bucking the trend. Instead of caution, investors have responded to its inline outlook with enthusiasm, driving its stock higher as it reports its biggest growth in comparable club sales in nearly 2 years. This divergence within the retail space calls to mind the classic adage that in every challenge lies an opportunity, and it certainly gives us something to think about.
Now let's further unpack 10 important developments that are reverberating across our markets today. First, we have the striking report of the U.S. international trade deficit reaching a new record high for January. With the deficit now at $131.4 billion, up a staggering 34% year over year, there's increasing concern that the current trade policies may be inadvertently weakening domestic industries. This record deficit has become a rallying cry for debates on trade reform, and many are wondering how policymakers will respond as the pressure mounts from both sides of the political spectrum.
Second, correlated with the trade deficit data is the ongoing discussion around export performance. Despite challenges in imports, there have been whispers of positive trends in exports, with some reports suggesting nationally coordinated efforts have helped boost the numbers. However, the positive trade balance in goods continues to be overshadowed by the deepening gap in overall international trade.
Third, labor market signals indicate a mixed bag. While overall jobless claims have eased from their peak 3 months ago, federal employee unemployment filings have surged. This dichotomy could signal structural issues in the way public sector employment is evolving, something that might require nuanced policy interventions in the near future.
Our fourth story comes straight from the realm of hedge funds. As we mentioned earlier, hedge funds still hold big, risky bets on the market, even if their recent sentiment appears less bullish. This tempered approach suggests that while the appetite for risk remains, there's a growing recognition that the market may be entering choppier waters, prompting a cautious recalibration among even the most seasoned market players.
Fifth on our list is the intriguing case of Intuitive Machines. The space exploration company is gearing up for a second moon landing, an event that should generate substantial excitement among space enthusiasts and long-term investors alike. However, despite the anticipated fanfare, the company's stock has been falling. Investors are weighing the near-term execution risks against the long-term potential of opening new frontiers in the space economy. It's a classic case of innovation meeting market skepticism, and it invites us to wonder, when does great ambition finally pay off?
Our sixth story touches on the retail sector yet again, focusing on Macy's stock performance. With its downward revision and guidance prompted by what it describes as external uncertainties, Macy's is sending out a cautious message. It's a reminder that even iconic names in retail are not immune to the complex interplay of global economic factors, from fluctuating consumer confidence to delicate supply chain issues. This news leaves us asking, how long will the retail giants continue to weather such headwinds, and what innovative strategies will they adopt to steer through these turbulent times?
Seventh, we have the encouraging news from BJ's Wholesale Club. Contrary to the broader retail gloom, BJ's is thriving by providing a detailed inline outlook. Its robust performance in comparable club sales, reportedly the best in nearly 2 years, is proving that there is room for aggressiveness in some segments of the retail market. Their essay and optimism could serve as a blueprint for how other retail giants might strategically pivot amid uncertainty.
Eighth, an unconventional yet engaging story comes from the healthcare sector. A hospital expert recently made headlines by advising, quite humorously, "Don't get your operation on a Thursday," suggesting that certain cost-saving measures could improve both financial and health outcomes. While the comment might have had a humorous wing to it, the underlying message is serious. Operational excellence in hospitals is paramount, and even the timing of procedures can have a substantial impact on efficiency and costs. It's these quirky insights that sometimes make your job as an investor feel like reading a well-crafted novel.
Ninth, in the food and grocery arena, we turn our focus to Kroger. The supermarket giant has rolled out a downbeat profit view for its fiscal outlook, citing factors that the company deems outside our control. This announcement from Kroger serves as a microcosm of the broader economic turbulence affecting sectors that might otherwise be considered stalwarts of consumer stability. When even the big names in grocery can't escape headwinds, it naturally leads us to ponder, are we witnessing just a short-term blip, or is there a more systemic issue at play?
And 10th, there's a significant development in the engineering and construction space. Willdan Group, a notable player in the utilities and services field, announced the acquisition of alternative power generation. This strategic move bolsters Willdan's electrical engineering capabilities and signals a robust commitment to expanding into high-growth sectors driven by energy transition and infrastructure development. In an era where technological integration in energy and utility services is rapidly evolving, this acquisition could well be a game-changer, potentially reshaping competitive dynamics within the industry.
Shifting our focus now to some detailed sector analysis, we start with technology and innovation. The tech sector, always the wild card in market movements, is currently facing a mix of headwinds and tailwinds. With companies like Intuitive Machines pushing the envelope in space exploration, we see an industry that is eager to add a touch of science fiction to its narrative. However, as with any high-concept industry, the risks are strong. Investors are reminded not to get caught up in the hype and to carefully scrutinize the underlying fundamentals. The technology sector remains a fertile ground for high rewards, but it demands the kind of diligent research and thoughtful analysis that separates the wheat from the chaff.
Across the energy sector, the dynamics are equally compelling. The acquisition by Willdan Group of alternative power generation is not just a headline, it is a signal of the convergence between traditional infrastructure operations and emerging renewable technologies. This blend of engineering expertise with a forward-looking focus on sustainable energy is exactly what many consider a bellwether for the next 20 years. For capital markets, this means that companies with substantial investments in research and technology, alongside robust management teams, will likely be the ones to watch as global energy trends shift towards decarbonization and smart grid technologies.
In finance, the cautious sentiment we see among hedge funds and institutional investors alike underlines a broader theme. The balance between risk and reward is becoming ever more precarious. With trade tensions, inflation fears, and the looming specter of interest rate hikes, financial analysts and investors are urging a more nuanced approach to portfolio construction. The market, it seems, is teaching a lesson in humility. Smart investors know that it is not about chasing the largest gains, but about protecting wealth in the face of uncertainty. The interplay between fiscal policy, monetary decisions, and investor sentiment in the financial sector is something that we will continue to monitor very closely.
Globally, these developments have serious implications. The record trade deficit is not merely a line in an economic report. It reflects underlying shifts in the global supply chain and international competitive dynamics. As countries recalibrate their trade policies in response to emerging trends and protectionist measures, the ripple effects will be felt far beyond the shores of the United States. Meanwhile, the mixed signals emanating from major indexes suggest that international investors remain cautious, but not entirely pessimistic. Regions in Europe and Asia may experience their own fluctuations as the world becomes more interconnected, and as each country adapts to an increasingly volatile international economic environment.
Now let's bring in some expert insights and predictions. Several market veterans point to persistent inflationary pressures as a key risk factor, even as central banks clamp down with tighter monetary policy. Others are more optimistic, noting that a recalibration in trade balances might, in time, lead to more sustainable global growth. One of the more intriguing questions we must ask ourselves is, can businesses innovate fast enough to overcome the current supply chain issues and restore investor confidence? And what role will emerging technologies, particularly in the renewable energy sphere, play in bolstering growth during these uncertain times?
I find myself asking the audience as well, when trade deficits and policy reforms collide with technological innovation and shifting consumer sentiment, where do we, as investors, position ourselves? Are we going to ride the wave of innovation, or are we setting ourselves up to be battered by unforeseeable economic storms? And what about those bold players like Intuitive Machines? Will they be the trailblazers of tomorrow, or cautionary tales of overreach? These are thought-provoking questions that invite personal reflection and deeper market analysis.
Before wrapping up our conversation today, let's consider a humorous observation about market behavior. It is often said that trying to time the market is like trying to predict the weather in a hurricane. Sometimes you get sunshine, even when dark clouds are all around. Perhaps then it is not so much about predicting every twist and turn, but about staying agile, informed, and ready for anything. A little humor aside, these realities underscore the importance of staying engaged with market developments, no matter how unpredictable they may sometimes seem.
As we draw our conversation to a close, let's recap some of the key takeaways from today's briefing. The overall market shows mixed signals, with traditional indexes like the S&P 500 and the Dow Jones experiencing mild declines, while the Nasdaq managed to hold on to a slight gain. Digital assets, namely Bitcoin and Ethereum, continue to oscillate within narrow bands, reflecting a cautious yet persistent uncertainty among crypto investors. On the macro front, the record-high trade deficit, coupled with mixed employment data, is providing fresh fodder for both economic debate and market strategy. Furthermore, divergent stories within the retail sector, with Macy's facing headwinds and BJ's Wholesale demonstrating robust growth, alongside notable corporate actions like the acquisition by Willdan, remind us that every sector has its own narrative in these volatile times.
Our discussion on sector analysis reminds us that the worlds of technology, energy, and finance are each charting their unique courses. While technological innovation continues to spark excitement and drive bold ambitions, the energy sector is undergoing its own transformation as companies merge traditional expertise with forward-looking renewable projects. And within finance, the balancing act between risk and reward remains as crucial as ever.
On the global stage, these narratives intersect in ways that challenge and inspire us as investors. Trade deficits, policy shifts, and market corrections all remind us that in a globally connected world, the ripple of a single decision can turn into a tidal wave of consequences. As our markets continue to evolve, the key strategy for every investor will be to remain agile, to focus on long-term fundamentals, and to cultivate an appetite for thoughtful, innovative investments.
I hope today's discussion has provided you with not only an update on the market numbers and headlines, but also a broader context to help you navigate the complexities of today's economic environment. The interplay of trade, innovation, and consumer behavior presents both risks and tremendous opportunities. Perhaps one of the most valuable lessons to take away is that, now more than ever, staying informed and adaptable is essential for anyone who wants to succeed in these markets.
Before we sign off, let me leave you with a few questions to ponder as you head into your day of trading and investing. How will companies adjust their strategies in response to this record trade deficit? Is the cautious sentiment among hedge funds indicative of deeper structural challenges, or simply prudent risk management in uncertain times? And finally, can the innovations in technology and energy truly create a resilient buffer against the increasingly complex global landscape? I encourage you to mull these over, and feel free to reach out and engage with our team. You can always ask questions to our AI co-pilot and join in the conversation.
Thank you all for tuning in to today's PAI Morning Briefing. Remember, learning shouldn't feel like a full-time job, and as you sift through the numbers, navigate the market trends, and plan your next move, don't forget that Pantheon AI is here as your information co-pilot, guiding you through the twists and turns of the financial world.
Join us again tomorrow for another in-depth discussion, and until then, keep your eyes on those trends, mind your strategies, and never stop asking how you can adapt better in this ever-changing landscape. Have a great day, and happy investing!